And that's why the mining sector in the West is capped. And that's the underlying problem for Western markets, is the incentivization is not the same as an emerging market, which has a much more diverse pool of capital.
Fascinating. I mean, we did a deep dive into Fortescue and as well been reading about like sort of Sino Gold and that sort of at the same sort of time when that kind of got started. And
Yeah.
it's crazy to read about, you know, Jay Klein at the time speaking about journeys that would take 15 hours, and by the time he sort of left the country in that venture, it's taking 5 hours because there's highways crossing valleys, there's, you know, plane trips going, there's airports being built in places where there's barely a city before.
Well, so sometimes there's no cars. So I remember we'd catch a train out from Beijing West train station like most Thursdays nights, and we wouldn't even know where we're going. We'd get into third class, we'd just play poker, eat nuts and drink beer in the train, and like all the passengers would come and play with us and talk to us, and then you'd get off somewhere and, you know, try and find a restaurant and somewhere to stay, and, you know, the next day you'd have 500 people outside of wherever you were staying trying to sell you something. You might get a couple of horses and away you go into the... Yeah, it's amazing. Like you knock on a door and say, "Oh, you know, have you got dinner?" And they go, "What do you want? Chicken, cow, pig?" You know, okay, we'll have lamb. They'd build a fire on the road outside of the house, and they'll put the lamb on it, give you some beer. You just sit. There's no cars going past. It's crazy.
What an experience. All right.
JD, we're joined by Willo today, and Willo, you're unlike any other guest I think we've ever had on our show, not just because you're an investment banker, and we usually don't let investment bankers on the show, but because, I mean, you've got one of the most unusual, I guess, stories, or like your own journey. You grew up in South Australia, went to high school in Japan, uni in China, 27 odd years with JP Morgan, SEB and HSBC, doing enormous kind of, you know, metals and mining M&A transactions. A lot of our listeners would be familiar with the likes of, you know, Jundee for Northern Star, or Red Chris for Newcrest, or Galaxy Orocobre, IGO Tianqi, Yancoal Rio. I mean, these were big deals. You were a part of them. These days, you've kicked off Pacific One, which is, you know, a business you own and continuing your career. I think you've got a pretty unique lens of the world, not only your history, your trajectory, but your insights into the kind of Asian capital world, having lived there, you know, speaking the languages yourself. We're delighted that you're joining us, and as we're going to kind of reflect on the week that's gone and some of the big themes that as we look ahead. Welcome to Money Mine.
Great. Thank you. Thank you, guys. It's a great service. I listen to you every week, and I know a lot of other people do as well. It's fantastic.
That's flattering, Willo. We're very excited, and I think for the reasons that Trav just outlined, your background makes you pretty uniquely suited for the conversation we're going to have. So,
although he's going to be cagey when we ask him about companies, mate, because every investment banker will actually not really tell you what they really think when you ask them about companies. It's good business.
Not publicly, yeah.
On the theme of geopolitics and cost of capital, where funding is coming from in the resources world, where it might come from in 5 years and 10 years' time, though, you're pretty primed. So I think we should start the conversation in that kind of spot, because we caught up a little while ago and we spoke about the big shifts underway, as well as your positioning in Asia and how you sort of see the flows, as well as your experience in working in junk bond markets, in debt markets. So I want to sort of start this conversation at a kind of broad level and understand what you think are the big trends in the cost of capital and how miners are getting financed as we sort of see it today.
Yeah, so if you're a Western listed miner, you've always kind of done it one way. You get project funding, you go to the equity market and you raise equity. And when emerging markets were pretty small, you know, that was the only way you did it. Some of the bigger projects the Japanese financed, you know, along with the majors, iron ore and coal and copper and other things, and that was very effective. And, you know, over the last 10 years especially, we've noticed that a lot of the Western countries have really been hollowed out in terms of their industrial capacity, and that includes mining and certainly processing. And one of the surprising things to me is a lot of the Western politicians don't actually try and solve the problem. They just band-aid over it with handouts. I mean, what is the problem? The problem is that the two things: Western equity capital is now a lot more expensive than emerging market capital. And I don't really like to call it emerging markets because China, Japan, Korea, they've emerged. They're the industrial economies, not the West anymore. So it's an average of 66% more expensive is Western equity capital when you look at very similar companies and a number of them over the last 10 years. So that's a huge difference. And then debt capital, I mean, that's very easy to reference. You've got Japanese and Chinese 5-year bond rates, which are below 2%. You've got US and most Western countries about 4.5%. I mean, that makes a huge difference to your IRR on a project. And so if you're just doing it with Western capital, you're competing against companies, whether government-sponsored or not, that are competing with far lower cost of capital and therefore much higher IRRs. And so how do you acquire a copper mine, for example, with a much higher cost of capital relative to your competitors? You can't.
To tap into that point, because I think we start talking about cost of capital and we're at real risk of losing the people that are not from a finance kind of background. So
it's everything. It's everything in a capital-intensive industry.
Yeah, right. Exactly. So if we can really break it down to the nuts and bolts and what the ramifications of a higher cost of capital are for, from, say, an Australian perspective or from a miner's perspective.
Yeah. So if you're a Zijin, for example, and you trade on 12 times EBITDA and you're buying something at 4 times EBITDA, fantastic, because that EBITDA just goes straight to your 12 times and there's value created. If you're trading on 4 times EBITDA and you're buying something for 4 times EBITDA, well, it's pretty hard to create value off the bat from that, and you certainly can't pay what Zijin can. So that's just a simple example, and the same applies to, let's say you're investing $1 billion of capital into a project and you need a required rate of return. That's very hard when your cost of equity is so low, so high. Sorry. And we've skipped over a little bit because the key point is why. Why is that? Cost of debt you can probably understand. The Western countries are in a higher levered, but why is cost of equity so high for Western companies? Given that all we hear is that the US market has higher multiples, and it does. It does for other industries. It does certainly for tech, and it does for infrastructure. Well, why mining? Well, if the problem with the Western equity markets is that they're now 85% institutionally owned, right? And what does that mean? That means you just crowd capital into where the LPs or the ultimate asset allocators want. And what do they want? Well, they're happy to have volatility in operational cash flows like tech, but it has to be capital light. So I have to be able to invest in like 10 of them to have 2 or 3 of them come off. Fantastic. And if it's capital heavy, well, it better not be volatile. So infrastructure, love that. In fact, I don't really care what I pay for infrastructure because I know the return that I'm getting. But mining's in between, isn't it? It's high capital intensity and it's very high volatility. And as a generalist, which I used to be, that's the worst of both worlds. Why am I going to bid more than 4 times EBITDA for a company like that? And that's why the mining sector in the West is capped. And that's the underlying problem for Western markets, is the incentivization is not the same as an emerging market, which has a much more diverse pool of capital. So retail in China, for example, is 80% of the stock market. Completely different. I mean, that's how Western markets were 50 years ago. And therein lies the difference in capital formation and the difference in capital cost. And then that gives an advantage to those companies. And it's not just China, it's Korea, Indonesia, India, Saudi. Yeah.
So when you think about the equity markets, though, quite famously, the Chinese broader indices, they haven't performed phenomenally well in recent decades. Say the last 15 years since the GFC. Despite that, they have gotten bigger. There is more and more companies being listed there. So the kind of gross market cap is growing, whilst the performance kind of hasn't. Is that something you think is part of the natural evolution, and in time will do well, or because of the system there that's not going to perform in time?
Well, when it's a retail-centric market, sometimes you don't get the valuations that you would in the US. So, if you go back 7 or 8 years, a lot of the Chinese tech companies listed in the US for the higher valuations. That makes sense. But most of the manufacturing, either directly or indirectly, and heavy industrials have all gravitated towards those markets. And either it's, chemicals, I think China is twice the size of the US and EU combined in chemicals output. So you look at a hydroxide plant, you go, well, why can't it work in the West? Well, you don't have the supply chain backing it up. You don't have the cost of the inputs that can compete.
And if we think about these sort of pools of money kind of traversing those two, east and west, with a specific example in mind, FMG a little while ago announced this renminbi US $2 billion bond deal. How do you think about those bits of financing? Because they're a relatively unique piece, or maybe the first of that kind of type of financing. Do you think that's something we continue to see more of?
So you should be able to get a lower interest rate because the underlying government bond is a lower interest rate in China, so that's great. But then because you're reporting in Australian dollars or US dollars and that's your functional currency, you're going to have to swap it back into that Western currency, and that's expensive, and that's the reason why a lot of people don't do it. But in the case of Fortescue, they sell to China and they can sell in RMB, and that would naturally hedge their RMB exposure and thereby reduce their net cost of interest. So it can work. It's not for everyone, but in 5 years' time, it'll be a lot more popular to do that.
Isn't that interesting, right? So they get a 2%. I mean, it's like, you look at it and you're like, this is the lowest cost of capital you can have as a Western miner. Lowest cost of debt, borrowing a 2% coupon on a $2 billion loan. But are they able to do that? And because like China has a political or will to want to de-dollarize as well. Like if they're selling in RMB, is there some advantage and incentive for that?
I think we all overestimate the government's hand in a lot of this. I mean, that is the Chinese banks wanting to expand outside of China. I mean, look at what they've done in Indonesia. The Chinese government, the Indonesian government, didn't have much to do with that, really. It was Tsingshan and a whole bunch of very private, very proud Chinese companies that put maybe 50 billion in capital now in Indonesia and nickel to build up all of that industrial size. And it's only now that the governments are kind of getting involved.
The capital came in because of the
government goal settings.
Yeah, the industrial park, like tax breaks for big windows of time and everything. That was the landscape that allowed capital to accumulate, though, was it not?
That was part of it.
Yeah,
part of it. But the capital from Tsingshan wasn't government capital. Sure, like every government, you have an industrial policy that encourages lending to certain sectors, but it doesn't dictate, we're going to go and spend $40-50 billion in Indonesia and ruin the nickel market.
Mate, we've just got to jump in with a quick public service announcement. We are one short week away from Africa Down Under, ADU, next week.
Less than a week, mate. The conference starts on Wednesday next week.
There's only a few sleeps to go.
3rd to the 5th, so it's a Wednesday to the Friday. We're gonna be there. Come check. Like, we'll be there Wednesday morning. So if you're gonna buy your tickets to come to Africa Down Under, now is the time to pull the trigger. If you're going to go, I don't even think there's many tickets left, mate. They're selling like hotcakes. So you better
hotcakes. There's a number of reasons why you want to get yourself down there. You've got the biggest African miners. You've got the up and coming ones. You've got the juniors that are doing big things. We've seen deals.
Don't forget the delegates from all of the different countries, mate.
Delegates. A lot going on that front. When you invest in Africa, you need to understand the playing field. You want to get in front of the face of these delegates. You want to speak with them. The
biggest African mining convention outside of Indaba. Phenomenal.
That's crazy. Yeah. Right here in Perth. Get your tickets in the show notes. Africa Down Under, September 3rd to 5th. Yeah, it is a fascinating example. In terms of more money that's coming into the metals and market space, traders and the commodity traders, with a lot of these guys being, energy first traders, they've entered the space. We saw another example just recently with Kipushi, the Ivanhoe mine, and a deal with Mercuria, who have always been an energy trader. Is that another sort of source of capital? I mean, they're really muscling in on one another now. Do you see that trend continuing?
That's fantastic, isn't it? Because go back maybe 7 or 8 years, there was a few big bankruptcies in trading companies, particularly in Asia. Honliong, I think, was one of them, and there was a few more. And so a lot of the banks pulled back from financing the traders into particularly metals deals. And you remember maybe 15 years ago there was all of that LME, all of those LME problems with security over, and then a lot of the banks got out of it. So it was very hard for the traders to get any size. And the metals market is 8 to 10 times smaller than oil. So it's like, well, let's just stay in oil and make money there, which a lot of them have made huge amounts of money. And now they need to expand outside of oil, and so metals is obvious. But Glencore and Traf have had the lion's share of the best markets. So now you've got 8 to 10 others that are heritage oil, but coming very, very aggressively into providing funding. So either offtakes or prepay or hybrid type structures that's different from equity. You can have equity warrants or debt, and it depends how it's structured. But the banks tend to sit behind those prepay facilities and lever it to between 50 and 80%. So the trading company ends up not having to put so much equity into those facilities.
And from another sort of source of capital, you've got the streamers and the royalty players getting bigger and bigger. If we kind of piece it all together, what do you make of the statement that there's a shortage of money for mining companies?
There's definitely a shortage of capital for mining companies at certain stages of their development. So right now, I mean, and it's fantastic that the Perth retail brokers and brokers are raising all this money for mining development companies, because that's really hard capital to get. So the exploration capital is a bit easier now to get, but the problem is when you come to actually funding the construction or the bigger capital, and you're a $50 million market cap company and you've got 400 million of capex to spend, how do I do that? And there's not necessarily capital available for that from traditional sources, and that's why we sit there going, you've got to look at layering your capital structure. So how do I get a Japanese trading house in here? How do I get a royalty structure in here? How do I do offtake? How do I then bring Japanese or Korean or Exim Bank debt in at the project financing level at a lower cost? And how do I layer all of those capital structures so that the equity market understands what I'm doing? It's not too complex, which is very important in an Australian context. And so my cost of capital is low enough that it justifies me doing the project.
That Hudbay example that we spoke about a couple of weeks ago, that feels like a prime example to put forward in unlocking like the first kind of steps of that with the Japanese trading houses coming in, right?
Yeah, fantastic. I mean, what a great result for Hudbay, both of them. But Hudbay in particular. So they've basically just taken all of the capex needs away from themselves. Mitsubishi comes in and funds it all. Hudbay was trading at round numbers, let's say 0.7 times. They've brought in capital at 1.1 times MPV. Great value arbitrage. I mean, everyone that can do that should do that. Even if you don't even need the capital, you should be buying back shares to reduce your equity count, because you're replacing expensive equity with cheap equity.
The inevitability of the world's need for these metals, it's just like, it's so compelling, it's so obvious. But where is the capital going to come from to bring these new developments online if it is scarce?
So it's not going to come from Western equity markets. That's where it's not going to come from. And where it is coming from is industrial, i.e. Korea, Japan, China, Indonesia, and emerging markets. I mean, the capital coming out of Indonesia now is enormous. And a lot of it we don't see because they might not be public companies, or they're not listed on ASX or NYSE, but that is huge capital.
Is that because they understand like the need for these materials, because they have the industrial downstream component in some respects, or they're tied to it in some respects? So they've got the foresight to think 20, 30 years in the future.
Well, yes, partly because if you live in Jakarta, or you live in Shanghai, or you live in Riyadh, you see masses of construction every day, and okay, things are growing. Let's get on board that train. But I think the bigger issue is when you're growing an economy, those materials are really important, and the security of those are really important. But more than anything, they're just arbitraging the higher cost of capital in the West. So they're saying, well, this is a gap in Western markets where it's too expensive for them to play, and maybe the processing's too environmentally unfriendly, and there's a whole lot of other issues, but that's a gap that our capital can play in, that we're not competing with the West.
Tell me more about the ways in which you're seeing this capital, find its way into Western projects.
So and this is the thing. You can't just go out to auction and say, highest bidder wins to be my partner. That's not how it works. I mean, these are big, sophisticated companies usually that have their own checks and balances and their own systems, and every timetable is different, and they're all looking for a different thing. So it's a bit of a challenge, particularly to a mid cap or a small cap, to you can go to Japan and have a whole heap of meetings, but what does that mean? And then how do I compare that to Korea or Indonesia or China or Saudi or UAE or India? There's no one you can go to that's going to compare all of those together and say that's what makes sense for you, because most of the service providers they either want you to raise equity or they want you to do a high yield bond, or they've done a few deals in Japan, so that's great, we want to go there, but they don't know about the other side of it. So it's very, they don't know about offtake agreements. So it's very hard to layer that capital structure efficiently. That's the opportunity for P1, isn't it?
I was going to say that's where a great advisor would sort of fit in. How do you piece in US junk bonds and that kind of market, because they've had an interesting history financing Aussie resource projects?
Yeah, so I was at JP Morgan for a long time, and they have a very powerful US centric high yield bond desk, which is,
I've heard Chris Ellison talk about it. Yeah.
Right, so it's a great market. It's not something to be scared of. Because before, you obviously had Fortescue, right, and that was a fantastic way of financing what they achieved, and
what no one else kind of would have financed,
right? Because you can get capital. It's just price, right? And I think actually Minrez said that on the call. Execution risk is not big. It's just a question of price, and that's great. It's bullet finance. So for 5 years plus, you can sit there and you've got the finance, and the next 5 year cycle doesn't really matter so much. But then you just simply roll it over, and whatever price it is at the time, that's how you've got to time it.
And the with regards to that priciness, the cost of that, how do you piece that in with what it might cost from these Asian kind of players that you think about? Yeah,
so I mean that's purely debt, and usually it's a little bit more costly than a loan, only a little bit, and that changes over time. So that's debt from Asian players, and leaving RMB loans and debt aside. A lot of the capital's equity-like. So, I guess the next step down is kind of offtake and prepays with warrants, so equity warrants to give a bit more of a return, and then you go all the way down to a Listco equity investment minority or an asset level investment minority, which completely different style of capital.
Yeah, and I suppose the growth of the Nordic bonds to finance more spicy types of projects is another trend that we're kind of pretty astute to at the moment as well.
Well, I think given private capital is growing so fast, that sort of structure is going to make a lot more sense and open other doors for mining companies. So the Nordic bond is, yes, I think originally it was for Nordic mums and dads at home, but it's just a structure that then you can sell to lots of different credit funds, and I think we'll see more structures like that over time.
So where does the cap, let's say Minrez raises money in the US junk bond market? Are they US investors, or are they investors that are actually like Asian centric?
I didn't set up that question, but that is a good question. So that used to be principally US investors. So that a book would usually be like 80, 90% US, very US heavy. But over time, all of those US funds have established their offices in Hong Kong and Singapore and other parts of the world. And so now the book is at least 50, US, Asia, and sometimes a lot more Asia heavy. And the reason for metals and mining in particular is that Asian issuance is much larger in metals and mining than it is in the US, because there's a lot of companies, there's a lot of need. A lot of the Chinese companies raise short-term debt and bonds from markets, and that's the way they finance themselves. And so if you're a portfolio manager sitting in Hong Kong, you're going, yeah, I've seen this sort of gold company 100 times before. I've seen this sort of aluminium company. I know how the supply chain works because I already have investments in bonds in a bunch of the peers. And that's why for metals and mining companies, Asia is a really important part. So is the US. But it's important to understand that they're two different buckets of capital.
So the way in which the I suppose the government forces in very recent history are trying to level the playing field from a cost of capital, it's I'll get angry kind of talking about it.
Please.
But it's frustrating in a lot of ways. Do you have the same frustration in I suppose the approaches we've seen today of government to lower the cost of capital of Western mining projects and companies?
Yeah, look, and we could talk about geopolitics for a long time, but clearly, the US is not as strong as it was 10 years ago. And China, on every objective measure, is a superpower. Like it or not, it just is. I'd say the West band-aids some of these problems. They're short-term, sugar hit, get a good headline, voters are happy because something's being done. But no one really understands, it doesn't appear that the governments really are even bothering to understand what the underlying problems are. What are the causes for a lot of these things? And then I'm sure some in the government are, but if they did, then you would form underlying policies to address some of those issues, not handouts and band-aids and sugar hits. And the problem is the more we sugar hit, the less economic it becomes. I mean, in rare earths, I get it. You need security of supply, and it's not that bigger industry, so it's relatively easy to solve. But what have you really done? You've now got a structurally higher cost supply of inputs into the industrial complex, and in the military. I mean, as we've seen in Ukraine, you need very cheap production to multiply your forces, and having high cost inputs is not the answer.
You said we could kind of speak for hours about this geopolitical theme, and I think we easily could. So let's tap into it for a bit, because it's kind of implicit in what we were talking about with the funding there. It's the kind of read through line. And is it going to be that easy to have capital flow from east to west and all these sorts of things? So do you see there being difficulty in countries like Indonesia, for instance, if we're trying to have that money come into Australia? Like, they're in a kind of funny middle ground between Asia, China, and Australia and the US. Do you see there being blockages on a geopolitical front to that capital flowing?
I hope not, because what is happening now is becoming a multipolar world, and lots of bilateral negotiations between countries, which are is different to what we've seen in the last since World War II. And if you're seeing that, I think as a company, you need to start to be multipolar as well. So if I'm thinking about what's the easiest way to equalize the cost of capital? Well, it's get a partner in with a lower cost of capital than I do and supplement my capital with that partner. Now, do I just pick one country and that's the country I want to go to? I don't think so. I think from now on, you need to be multipolar. You need to have a Japanese partner, a Korean partner, a Chinese partner, an Indonesian partner, an Arab partner, an Indian partner. I mean, that would be fantastic. and then none of them have power over you, but you have access to each bucket of capital depending on what you want to build, expand, buy, because it's all different. It's all different costs and it's all different terms and they're all different cultures.
When you think about the mining companies that could potentially do something like this, you'd have to be of some sort of scale. And at least in the West, there's really not that many mining companies that are of sufficient scale that could have the bandwidth to set up relationships in all the countries you've just mentioned. Do you think I'm right in saying that?
Yeah, so I think Sumitomo Metals just put 5.5 million into Mirador, for example, and you know, how does that form? How was that originated? How many counterparties would have Mirador talked to before they decided on that? I think it's really hard to navigate. And then, you know, you go to the Middle East and you can fly around for weeks, and I mean, it's a big place. There's lots of cities, and they're all different countries. You know, it's not a and you know, Asia's obviously very different depending on the countries as well, and it's for a lot of the companies they some of them will see a lot of the counterparties, but they'll often be the traders as opposed to the investment guys. And so, are you really talking to the people that you need to talk to influence an investment decision?
And do you think one of the other sort of ramifications of this multipolar world is inflation?
Yeah, undoubtedly. You know, because if we're reducing the efficiency of the supply chain, then you're getting cost imposts at every point, and the more closed you get, the higher inflation you're going to get, particularly if you reduce interest rates.
You've got some interesting views you shared with us when we caught up a couple of weeks ago, mate. Just in relation to how people might choose to combat inflation and look for stores of value. Do you mind sharing that?
Yeah, right. I mean, this is obviously all very personal opinions, but you know, if I'm a government anywhere else than the US, I historically have just looked to US treasuries as my store of value. That's where most of the world look to store their value, and now that's looking less certain, and certainly you don't want to have most of your wealth parked in that store of value, and so gold and Bitcoin and maybe silver are the first places to turn to, because there's no real alternative. Like a digital RMB currency is not ready, and people aren't ready to accept that wholesale yet. So where to next? Because gold's only a certain size and it's already gone up. Bitcoin, not sure whether that's a store of value or a good way to transfer value. But if I was a Middle Eastern government, I would start buying and storing metals with positive contango. So they're, you know, aluminium, copper, zinc, nickel. And I mean, that is a store of real wealth. It can't be taken away from me because the property laws change in a country. It can't, it's not going to change because someone changes interest rates, or I can't move my money from here to there. It is a real store of wealth. And I think that's probably the next leg in metals, as everyone searches for somewhere to park their reserves.
That has pretty real borders to it as well, because of the physical kind of constraints of a lot of these things. And you speak about doing it with gold, but gold being a finite kind of market, it's the same issue with a lot of these. So we're not there yet, but they'll touch a boundary, and if, you know, a number of countries of significant wealth tried to do this, you touch that boundary pretty soon as well, don't you think?
Yeah, I think we're starting to see it. I mean, there's a lot of economies that are slowing. You know, the industrial output of China, for example, has slowed. Steel's slowing. You know, and that naturally feeds into copper and other metals. But we're not necessarily seeing those metal prices weak. I think because we are seeing a bit more storage that's off LME and off, not public.
When you say like storing the ones with positive contango, are you talking about any financial trades to go along with just buying the physical and storing it, or you're just saying that the ones with positive contango would be more attractive in general?
You could do. I don't think you'd make it that complex necessarily. You just want to store your wealth in a diverse set of assets, particularly ones that can't be taken away or don't inflate away. So it doesn't really matter what inflation is when you've got metals, because that's going to match or better inflation.
This could have pretty severe implications on metal prices in a pretty short period of time if multiple like Arab countries come to a similar conclusion at a similar point in time and start doing that.
Yeah.
Even worse than that, if you think multipolarity could be bad for inflation, what this could do to the price of a computer, or anything, a fan, an air conditioner, would be pretty huge.
Right. I think we're living through the start of a massive change in geopolitics, which is exciting and terrifying at the same time.
And I tend to think with these things that people don't really act until the problem is really in their face, or the problem has started to happen. So the value
we've got to lower interest rates, right? Because people don't think inflation is going to be an issue.
The value of treasuries really has to start deteriorating to a serious degree before people will act on these things. And maybe they diversify their measure to euros, yen, Bitcoin, gold, and then you start to see the metals kind of move.
Yeah. I think look, there's a natural status quo bias that you want things to remain the same because that's the easiest way to think about the future. But ultimately they never do, and it's usually long cycles. But that means when they shift big.
And for the mining companies out there, this would in effect pull up the bridge behind them. The ones that have built the project would kind of get to the promised land-ish because they are now receiving higher prices, but the builds to build a new mine would go up significantly because the input costs go up. So it's got a kind of compounding effect. So how do you think about the mining companies in this world?
So that's right. So you'd have inflation of costs, but you'd also have a lot more M&A where it's not just countries, it's going to be families and big companies with big reserves. They want to store that wealth, and for gold in particular, but also other metals, buying metal in the ground is still metal, it's just not mined yet. So that's still a hedge against inflation and geopolitics. It's just that you're owning land. So I think it's got big positive implications. So, and bringing this back to maybe a mining company, running a mining company is hard. It's not just the financials, and it's it is native title, it is regulatory, it is you've got so many moving pieces, and it's very, very difficult to go from a explorer and a developer to actually constructing a mine. But please keep going because I think the rewards will come.
And I feel like with all the topics we've spoken about, Willo, there's one we need to piece in here, and that's energy. Because energy, when you think about like the cost of energy in China versus the US and where that's kind of heading in a world trying to combat climate, it is a significantly moving part, especially if we pull in the Arab states as well, which have a very cheap cost of energy. So what ramifications does the price of energy have on all these things that you've been thinking about?
Well, I think it's so yes, it's energy, but it's more using that as a concept. So what the US was really good at in the 40s, 50s, and 60s was underlying productive infrastructure, right? And that includes energy. And so, let's just take a few of the building blocks, so the inputs into some of these processing units. So, China has twice the electricity capacity of the US. That is amazing, and building absolutely massive infrastructure to underline that advantage. It produces twice the chemical content that the US and EU does combined. Right, that is just such a big advantage in unit cost. In rail freight, it's about twice as big as the US. I mean, in mining engineers, there's 20,000 mining engineers every year graduating in China. There's maybe 1,000 in Australia.
Way less.
Yeah, exactly right.
Way less.
The scale is just a completely different size, and all of that is in productive capacity. It's not in super yachts, and it's not in watches, and it's not in handbags anymore. It is in productive capacity. That is very, very powerful, and then it multiplies over the rest of the economy.
But China, you'd imagine, would want to get to that higher level where brand attaches value and you can become a service type economy. Like this is what all these other countries did a while ago.
So yes, and I guess we all sit here going, oh well, labour cost is cheaper in China. It's not that much cheaper in some ways. It's more expensive, but labour is not a key input into a lot of this anymore because robotics is kind of taking out. So where do we care whether robotics are in China or the US or any other country? We don't. All we really care about is the other input costs like electricity, chemicals, copper. You know, what makes robotics? Rare earths, copper, aluminium. You know, where does 60% of the world's copper go to? China. 6% goes to the US.
Geez, there's a lot to think about there.
Mate, there's a lot to reflect on in the whole, that entire bit, you know, super fascinating. I feel like those are the themes that are going to kind of define the next decade in our industry, in geopolitics for sure. And yeah, appreciate you sharing them. We're going to pivot to talk about some news of the week, and this is like a relatively new thing we've been doing, Willo, but grade control is one of the segments where, you know, we give a letter A to F on a certain kind of corporate action of the week. Are you up for that? Are you actually going to give grades to companies?
Yeah, because I'll give them all A's because they're other clients.
Prospective clients. First up, BHP have signalled that Nickel West is up for sale again. Now, to give you a slight out, you can get creative on the grading. I'll leave it at that.
Well, I think all of the majors need to simplify, like Rio just announced as well. And you know, if they're not going to productively develop and harness these assets, then let's try and maximise value by working out who's the best operator and owner of those assets. So I think it's a great idea that you concentrate on your most productive assets and give someone else a chance on the others.
Yeah, I'll give them an A when they actually like transact here. I think they're going to have to pay someone to take Nickel West off of them because of the pretty inordinate rehab liability associated with what's happened at Camp Alberta there. But I mean, this, you know, the return on capital they were getting in the nickel business, even in the years before the nickel market went to shit, were like atrocious compared to the other parts of their business. This wasn't like a game changer for BHP. It's like a social project to keep big employment in WA, and I think they were kind of just stuck with it. You know, they're finally going to part ways with it. It'll be a change for West Australians, but it's kind of inevitable.
So what if no one buys it, and then the government's forced to keep it? Because why doesn't BHP just go to the government and say, well, you gave a handout to all of these guys?
They already did.
Yeah, they
already did. Right? That was like, you know, they put the foot on the government's neck in the lead up to them actually announcing that this would go into care and maintenance. I mean, the cost involved to restart a smelter.
But since then, to your point, like Nearstar and all these guys have got handouts and likely more handouts to kind of come. So it's a really sort of poignant question to frame, and let's hope we don't get to that.
So what if the government comes back and says, what if the only buyer is Chinese of the smelter, not the mines, and they've got the tech and the capital to fix it and create jobs?
That's a very interesting question.
Is this the first big test of FIRB?
That would be a big test.
Right.
Yeah, that would be a big test.
What the Chinese did with us for 30, 40, 50 years was have joint ventures. We would go there, there would be JVs, and we would learn, and it's, you know, eating a bit of your own humble pie, but bring them in and have it as a joint venture where we actually learn why they can do stuff so much cheaper. And, you know, maybe some of those things actually aren't attainable for us, but there sure as hell will be a few things that we can learn from, and that could potentially be one way to put forward a solution.
Can you imagine the car industry in Australia without Toyota, Mitsubishi, Nissan, GM and Ford? And we don't have an industry.
Yeah.
So maybe there's a bit of that.
Yeah.
Anyway.
Yeah. we might need to get creative on a solution, and I'm sure BHP is already having to.
I'd actually prefer further prove that than see some other form of like government handout or bailout here. If that happens, I'm changing my citizenship, mate. I'm done.
Welcome to Singapore.
Does China need a new citizen? Oh, maybe I'll join that.
All right. Next one that I want to talk about is WOF. Just very recently come out with the trading halt that Burkina wants to up their stake in the Kiaka subsidiary. What do you grade this one?
So it just underlines, well, let's grade it an A because, they might be a client later. But it just underlines how dangerous emerging markets are. I mean, so it's very hard for a junior to have any kind of political force in a country like that. But even if you look at EGA and their dispute with Guinea, I mean, EGA's just pulled out and they've had their license taken away. That's 1.4 billion in capital that the UAE put into Guinea. I mean, I think someone in the UAE is going to notice. And why did Guinea do that? Well, there's a few other countries that have some influence over the Guinea government, don't they? So,
well, as I understand it, they did fail to meet a few promises, so it's not completely black and white in the Guinean scenario.
Yes.
Yeah, I mean, I think you're bang on right with regards to WOF. Like the EM risk is something we've all kind of been aware of, and that's why they've traded it at such a low multiple. Like, they've had a great run the last sort of 3 years, but they've executed phenomenally, and they are on the cusp of doubling their kind of production. So very, very curious to see what the outcome is.
You love WOF because you see the cash flow they make, but you're like the true test. You talk about the true test of Fed, but the true test for WOF is like, can they ever get that money out?
But they've had 5 of these types of things in the last few years, and every time they've just bounced back within a couple of days.
But they're like, that's the there'll be a government coup or whatever, and they do. You always buy the dip on the coup or the whatever
but there was a change in mining code as well, and this is like hey, you're not being grandfathered. You're jumping on the new code, and let's see what sort of valuable consideration turns out to be.
If they can't spend the money like X, like that they make it at Kiaka and Sanbrado, if they can't spend that X Burkina Faso, then all they can inevitably do is just like reinvest in the country, become a larger portion of Burkina Faso's GDP, and become more beholden to the government in the process. Like at that point, you
Argentina.
Yeah.
Exactly the same. Yeah. Until recently.
Yep. Next up, what have we got? Mining services, a bit of a slightly change in tack here, but the mining services multiples have expanded dramatically in the last month to 2 months. Curious to hear how closely you pay attention to these ones, Willo.
Sure. So I think it's a wide variety of different companies, right? And if you're just doing dry hire, big trucks that are capital intensive, and you're a small cap, you're never going to win. That is never a win because your cost of capital is always going to be too high to compete with, particularly McMahon, which now get their money from Indonesia, Burma, Indonesia. How long will Tees be around? So that big dump truck open pit stuff is difficult, and I suspect you'll see some other capital coming in to support the existing players or form new players. The industry leader is probably FLS Smith, which is a Danish company, and it does a lot of the processing equipment and conveyors and a whole bunch of different stuff. They trade on 9.5 times EBITDA, and it's 80% services, mining services mainly. But sorry, the other bit of that is that underground services are completely different, and it's really difficult to find skilled underground people.
The skill set of being an underground, mining service provider versus open pit is very different. It's more specialised being underground, and that specialisation is scarce. But the people who have that specialisation, JD, of underground service providing or underground mining, they always repeat one thing to me whenever I talk to them. We use Sandvik ground support. It's the mantra.
Sandvik ground support. Just like the best people want to work with the best people, the best people also want to use the best equipment in the industry, and that is provided by the team with the R&D squad at the cutting edge of technology, Sandvik Ground Support.
Not just the best ground support, mate, but the safest ground support, the most innovative, like you talk about, and they too have the best team.
It's true, and it goes one step further. They've also got manufacturing and distribution hubs in every corner of the world, so they can get on the phone with you quickly, or you can just put your order in through the new app that they've got, and they can get that out to you quick, smart, so that you keep getting the tons out of the ground and keep producing that metal that makes the world go round.
I don't think there's ground that can't be supported by Sandvik Ground Support.
Go Sandvik Ground Support.
And management teams. And when we're talking to non-Australian capital providers, every conversation is stop looking at just the geology, start looking at the management team that is going to produce the value, because a really good management team can produce huge value out of a average geology. A bad management team can destroy any geology.
There's not all mining services companies are the same. Not all of them are capital intensive. A lot of them are, but like some of them are capital light.
Osenko, you had Zimmy on the other day.
Yeah, and like that's a great example of parallel that is still listed on the ASX. Like G&G, like you bring up the chart, $4.40, trading on I saw one broker note trading on 24 times FY26 earnings now. Like kind of remarkable multiples. But if you go back in time and you back to when the period that Zimmy was talking about with Osenko, the multiples that he was talking about with Osenko at one point in time were just astronomical as well. Like we have lived through an era where mining services multiples were crazy.
But where are all the new mine builds?
Yeah, and now we're seeing like ASX listed mining services companies, both capital heavy and capital light, expanding pretty heavily on the. You can see that on the focus charts we'll bring up right now by Market Tech.
Yeah, I mean it's great to see them actually get a bit of love. So I'll give it an A for that, because so many of these companies, their share prices in the doldrums for years and years and years. So you can expand that to McMahon's, like you mentioned, MAH, Parenti as well. They're well north of $2 now. So they're all having their kind of day in the sun, and we'll kind of see how they capitalise on this opportunity if they kind of can.
Last one to give a grade to, Willo. 2 days ago was the 20th anniversary of a very interesting kind of corporate event in Australian mining history. It was the 26th of August 20 years ago was the day in which Rio accidentally let their Shovelanna iron ore project tenements lapse. This junior Kazali picked those up at the time. Now then there was this big court battle that played out. You know, you were paying attention to markets. I'm sure you remember this. We had to learn about it in history books. But Rio ended up kind of, arguing about how this all played out. Apparently something got, like they wanted to, renew their tenements, but something got caught up at a post station in like some remote part of Australia. Anyway, but it lapsed. They did, things in and Kazali picked them up in short order. Now, in the court battle that kind of played out, what Rio did is they argued that it was in the public interest for the tenements to be given back to them, even though they lapsed. And they suggested that they would develop these tenements, not themselves, but they'd do an asset swap with BHP, because Shovelanna is in BHP territory, surrounded by BHP infrastructure, not Rio's infrastructure, right? So, okay, we're going to develop it. And amazingly, right, the ministerial decision comes in. The minister kind of overrides everything and gives the tenements back to Rio Tinto. 20 years later, oh, by the way, Kazali had to pay the legal costs for Rio. 20 years later, Rio Tinto's still not done an asset swap with BHP. The project is undeveloped and it's worthy of being developed. Like the grade of this project is, it's above the average grade that the majors are producing today by substantial margin and great impurities and the like. So how do you rate Rio Tinto and the government on the decision to actually give the tenements back to Rio Tinto?
A+ for Rio, obviously, and special mention to the lobbyists.
They earned their fees there. Yeah,
and I don't think we need to mark the government, do we? That's above all of that.
We can mark the government here. Yeah, that's an F for the Australian government. That was clearly not in the national interest, and
giant F
for Kazali to have to pay the legal fees for just being smart and on the ball. Yeah, Yeah, a fascinating one. All right, let's move into sweet and sour deal. We've got a few to run through here. I want to start with capital raises because we've had a few juicy ones. First and foremost, Linus, $750 million. These guys are capped at nearly $14 billion today. The share price has run dramatically. I'm kind of gobsmacked by this one. How do you sort of think about this sweet or sour deal, and what are your thoughts on it, Willo?
Great time to raise capital, so why not, particularly when there's a whole bunch of public capital coming in to help a lot of the other potential competitors, and that's probably not going to be positive for Linus's profits, are they? So, yeah, let's raise capital.
I think you're right. I mean, this is just over 5% dilution. That is.
Mate, it's a great deal for them. Raise the money while, like...
Got to feed the ducks while they're quacking.
What'd you say? They were trading at 24 times last 12 months for revenue. Like
just reported $8 million in
a capital intensive business. It's a truly remarkable valuation. If you
they trade on a big premium to the Chinese rare earth companies, by the way. So that's fantastic. That's
great.
There you go.
Are they worth it?
I'm not an equity analyst.
Of course. Okay, Cyprium. This one more in your wheelhouse in the sense that the Tanito Group took a 9.9% shareholding. They upsized this from a $60 million raise to an $80 million raise. They were a $60 million market cap coming into this raise.
They did have a fair bit of debt, though. There was a combination of the con notes.
And they'll pay down some of that with
debt.
this.
Yeah.
Yeah, sweet or sour deal?
Sweet.
Yeah.
Sweet for them.
Doing the right thing.
Raise the capital, organise the capital structure so that they can fight another day. If bringing in a family like that is a better way to get a better outcome for the equity raise and lower your cost of capital, then that's what you got to do. Yeah.
Do you think doing the equity raise at the corporate level was, and the dilution involved and everything like that, like could they have structured something differently at the asset level, or do you think it's the structuring's fine as is? Like,
maybe, but there's a whole lot of issues with the capital structure already with the offtake and other parts of how they acquired that asset. So I think they were probably, their hands were tied and equity was the easiest way to address it.
Gotcha.
Fair enough.
I'll give it a good deal as well. I mean, it was done at a pretty tight discount, and they've raised an enormous amount of equity relative to what their market cap was, and you don't always get to do that at a pretty tight discount. Yeah,
good deal. Markets are open, and take the capital and see if the asset can move one step closer to production.
I don't even want to mention the other two really, but some more troubled kind of company. Cyprium's historically troubled company as well, don't worry. But like Peninsula raising $70 million, they've just had a whirlwind of issues in relation to production woes combined with contracted revenue. And Core Lithium, they raised $50 million this week as well. Any thoughts on either of those two, Willo?
No, but when the ducks are quacking, you raise equity. That's and I just question, so for all of these companies that are raising a bit of equity, but maybe not enough to get them to the next step. I mean, what's the next step? You've raised enough to kind of just keep it going. How do you get to the next step? Are you coming back to the market?
Bit of a hope strategy, right? Like they are taking advantage in the Core example that the lithium price has kicked up, but do you just have to wait for the next kick up?
Well, maybe you wait for the next kick up to raise the capital you really need to achieve all your plans.
Yeah, I think on that point you've kind of got to give them credit for taking the hit and getting the capital on board.
Yeah,
but it does leave you in a bit of no man's land there in a sense. The Peninsula one was like a coalescence of various debacles all coming head to head. So we'll kind of see how they move forward from here.
They've had a few final raises, but they have the strategy of keep coming back, unfortunately. So yeah, hopefully this one is the last one for them. I'm going to give. I'm going to give these ones a D, just because when the ducks are cracking, like you raise equity, I get that, but I do think when you have the preponderance of equity raises, it actually dilutes the total capital. Like there's so much capital willing to participate in the space. What can that capital do? It can participate in in equity raises of like, I don't know, mediocre opportunities, or it can find a home in companies and development opportunities that that have legs. And I don't love seeing huge raises for mediocre projects because it just kind of cannibalizes long run capital availability, in my opinion. So I'll give him a D.
Controversial.
Yeah.
Alrighty.
Good projects, not. Yeah.
Alrighty, let's talk about a couple of hidden gems. I know you've got a few thoughts on this front, Willo. Books or podcasts or places of interest that have sprung up recently that you want to share?
Perth weather's colder than I thought.
We're coming out the back end of it. Don't worry.
Not really. I'm a big reader and listen to podcasts a lot, and a few books came to mind that might be helpful that I thought were really good. Goliath.
What's that about?
Goliath is about the history of antitrust in the US, which basically shows the long-term cycles from the mid-1800s through to now, and how the governments have kind of managed, to break up Standard Oil and put it back together.
Busters.
So, and it goes just beyond blue and red, but to much longer-term cycles, and we're in one at the moment. It's fascinating to then, to look at the 30s and look at now, and it's very, very similar. In 1923, Andrew Mellon had a monopoly over aluminium. Well, what's the first thing when he became, believe it or not, finance secretary? Well, put up tariffs for aluminium. That's easy. Yeah.
That is great. That one's going on the list. Any other?
Oh, sorry. History of uranium. Mate, just give me 1 minute on this. It's fascinating. So, World War II, biggest producer of uranium in the world is DRC. Fine. It's owned by Belgium. Germany invade Belgium. First thing they do is bring down some ships to DRC and go, where's the uranium? And they've gone, oh, no, they've taken it. They've flooded the mines. It's all gone. And a couple of weeks later, a Belgian delegation turns up in the US and goes, we've got something you might want. It's a whole bunch of uranium. They go, no, we've got plenty. We don't need any of that. And they go, that's fine. Here's my card. If you need some a bit later, you've got my number. About 6 months later, they go, yeah, okay, we get it. We'd like that, please. Please come in. Let's talk about it. And so he comes in and they negotiate price, which I forget, maybe it was $20 billion, the biggest ever foreign deal that the US had done at the time. Confirmed that the money's changed hands, and the US is going, right, well, where is it? Where is it? And he's throwing the keys across the table and going, it's down in Dock 46.
That's such a great story.
Yeah.
That one's definitely going on the list. You've got a few others there that stick out. Chip Wars.
Yeah, most people have read Chip Wars, which kind of talks about the semiconductor supply chain, which is fascinating. It has a lot of similarities, or it rhymes a lot with a lot of the metals supply chains. Choke Points, which is written by the same guy, which talks about the financial or economic war that countries wage against each other, and the US-China thing's pretty interesting for that at the moment. Two that are kind of unrelated to mining: The Brilliant Abyss, which is all about under the sea, which when we think about seabed mining, which I think is a good idea in some circumstances, we've destroyed so much of the sea thus far. It's just important to kind of understand what we're destroying before we just blindly go and do it. I'm not saying seabed mining definitely does that, because it doesn't in most cases, but and the other one is The Hidden Life of Trees. I love this stuff. So it's about old growth forests and how they communicate over thousands of years. They support each tree has personalities, and they support old stumps that died for, sometimes 250, 300 years, and others that they don't like, they'll just let die. It's pretty cool.
That's remarkable. I'll have to do a bit of reading myself there.
You're a student of history, Michael. So
Love it.
how's the history there going to inform any decisions or positions you make right now?
The book I don't have in here is called Range, which compares, I'll get back to your question, which compares Federer to Tiger Woods and how they were brought up. So Federer played I don't know, 20 different sports, and then, just decided, oh, well, I might as well play tennis. And that's why he's so naturally skilled. But Tiger Woods only ever played golf. But I think just all of these inputs, so, understanding equity markets, understanding industrials, not just mining, because a lot of people in mining have only ever done mining. They haven't, understand different languages, different countries, different systems, and read broadly. That gives you a lot more pieces of the puzzle that you can put together to form a solution. That
multidisciplinary learning.
Yeah.
And a couple podcasts to wrap it up.
Oh, the rest is history. And Empire, with great stories, but they're running out of history now.
600 episodes in.
Yeah, and Multipolarity, pretty honest take on China-US relativity and EU politics, and that's pretty cool.
All right, on the theme of podcast, most people I've sort of spoken with, I would have rambled about this one, but Founders is a fantastic pod.
Yeah.
And on the book front, recently read The Big Rich on the Texan oil families. The 4 families that dominated that over the last 150 years was fascinating. A lot of parallels with resources. And with Texas, there's seemingly a lot of relatability to WA and our uniqueness, which was fascinating. And read over the weekend The Rise and Fall of Alan Bond, an interesting kind of take, but awesome to learn about WA in the 60s, 70s and 80s and that kind of era. So there's a couple in the mix. Thank you so much for joining us, Willo. The way you think and the experiences you sort of bring to the table are fascinating and make for such a rich conversation. So I appreciate you making the time for us.
Yeah, thanks for having me, and congratulations on a great show.
Do you want to help us thank our partners, Willo? You can hang around for this outro. Thank you so much to our partners, mate. We've got Axis Mineral Services. They crush rocks from big to small.
They do. Sandvik Ground Support, the only name you need to know in the ground support industry. Africa Down Under. Tickets up for sale right now. Conference is next week from September 3rd to 5th. And last but not least, mate.
Focused by Market Tech. Hootaroo.
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 I'm an idiot. JD's an idiot. If you thought any of this was anything other than entertainment, you're an idiot and you need to read out a disclaimer.